Hello everyone. I hope that the preparation of exam is going very well. I just want us to take a few minutes just to go through the theoretical part of the bank recon. I've been getting some queries when it comes to the bank recon, so I just want to talk through this. Maybe this will make sense. Let's not waste time. The bank recon, this is what I'm going to focus on now. This is my contact details. So firstly, I just want us to talk about the bank statement because I realize that most people confuse the bank statement and our bank account. Remember, when you open a bank account in your business, the bank account is classified as an asset. To be specific, that asset is called current asset. So remember, all the assets increase on the debit side. Remember the rules of assets. So it's when, for example, you open a bank account in your books, you say bank account is an asset. It means when you receive cash, you will record on the debit side of that particular bank account. Remember, the money that you received, which you have recorded in your bank account in your books by your accountant, that money must be deposited into the bank. So in other words, after depositing that money, remember we've got the record that we received that money in our books. Now we go to the bank. For example, here I'm using net bank. So when I go and deposit this money into the bank, so the amount must be reflected on the bank statement. Okay. So to show that I deposited that money, so the bank statement must show a credit balance. I think you understand. Remember, in my books, in my business, I show that as a debit balance, but the bank will show it on the bank statement as what? As the credit balance. Why does the bank credit me on the bank statement? It's because in the bank's books, I am their liability. They owe me, and their liabilities increase on the credit side. So don't confuse the two. You need to separate your business books and your bank statement. So the bank statement comes from the bank. So the bank will treat you as a liability. So they owe you. That's why here I said I'm referring to the bank statement here. So the debit means money went out, and the credit means money came in. So this is in the bank's books on the bank statement. But in my books, it will be the opposite of what the bank does. I hope this one makes sense. Okay. Now, you know that the reason why we have got what we call the bank record is the fact that our cash books, when I refer to the cash book, I'm referring to the cash receipts journal and the cash payment journal. Some books call it cash book receipts and the cash book payments. So, for example, if I receive a cash of 500 in my books, I'll record that cash in the cash receipt journal. Remember that cash must be deposited into the bank. So even my bank statement must reflect how much? 500. But this is not always the case. Sometimes you can find that I deposited an amount of money in the bank, but when I check my bank statement, that amount does not reflect yet because of things like, I can just say, temporary differences. For example, I can go to the bank and deposit only to find that the bank is offline. They will receive my money and then they can only update the bank statement when they are online. Can you see, for time being, the 500 that I have in my books is not reflected on the bank statement. Can you see now? That's how we need to reconcile the differences. Okay, remember, even in real life, when we've got differences with someone else, sometimes we try to reconcile because we know that in a short run, sort out those differences. So the same applies to the books of the business. So what we paid here is not reflected on the bank statement. So it means we've got differences. As you can see here, those differences can either be adjusting or timing. What do I mean by saying that? So if, let's say, for example, I've got 500 under cash books, it can either be cash, let's say cash receipts journal, and then that amount does not reflect on the bank statement. We call that what? Timing. Can you see now? But when the figures appear on the bank statement, but not yet in our books, we call them what? Adjusting. I want you to get this right. Adjusting is when the information appears on the bank statement, but not yet in the books. We call that what? Adjusting differences. It means we must come and adjust our books. For example, let's say you are running a business and one of your customers pay you via EFT. Remember, you can only be aware of that EFT when you receive the bank statement. At the moment, the bank statement is reflecting that amount of money that you have been paid, but because we are not aware, so that amount is not yet reflected in our books. We can only adjust our books by the time when we receive the bank statement. So those figures are called adjusting differences. They appear on the bank statement, but not in our cash book. But if, let's say, for example, they appear in our cash book, but not on the bank statement, we call them what? Timing differences. Are we together? For example, I go to the bank, I deposit 500 rands in the bank. So remember, in my books, I know that I record that I deposit, I've got how much? 500. But when I go to the bank, I deposit, and the bank statement does not reflect that amount yet. That amount will be called what? Timing difference. Timing differences appear in my cash books, but do not appear under what? Bank statement. Are we together? So we need to make sure that we understand. Okay. But remember, all the adjusting differences will be recorded under what? The cash books. Remember, the cash books consist of cash receipt journal and the cash payments journal. But all the amounts which are called timing differences, meaning they appear in my cash book but not on the bank statement, they will always be recorded in the bank reconciliation statement. So timing differences will go to the bank reconciliation statement, but the adjusting differences will always go to what? To the cash book. Now, let me talk about the errors. Remember, sometimes we make the errors. Sometimes errors can be made by us as a business. Sometimes they can be made by the financial institution on the bank statement. For example, you can find that maybe in my receipt, I recorded 500 instead of what? Of 400. Can you see now? So that is let's say an overstatement. So the error which has been made in our books must be recorded in our books. Can you see now? So errors which have been, let's say, one of our accountants or our bookkeeper made a mistake by recording in the cash book, we will record those errors, we will rectify those errors in the cash books. But if the error has been made by the bank, that means it is appearing on the bank statement. That error will always be rectified under what? The bank reconciliation statement. So you need to be careful when there's an error. Check who made the error between our business and the bank. So if the bank made an error, it means that error is reflected on the bank statement. That error must be recorded in the bank reconciliation statement. But if our accountant in our business made a mistake in our cash book, it means that error must be recorded in those cash books. But we'll look at it by the time when I show you a practical example. I hope it makes sense at the moment. These are examples of what? Adjusting difference. Remember, I said the adjusting differences are always recorded in the CRJ and CPJ. Remember, CRJ and CPJ are together called what? Cash books. So meaning these are the items which are appearing on the bank statement, but not yet in our cash books. For example, we've got the bank charges. Remember, the bank statement reflects bank charges. We are only aware of the bank charge when we've got the bank statement. It's then that we must go and record the bank charge in the cash book. But we need to be careful whether we must record in the CRJ or CPJ. How can we know that? Obviously, if the business has to pay that, it will be a CPJ. But if the business has to receive that, it's going to be a CRJ. So the business pays bank charges. This will be the CPJ. The business receives interest on current account. This is a CRJ. The business pays interest on overdraft. This is the CPJ. Debit orders, outflow of cash, CPJ. Direct deposit, we receive, CRJ. Dishonored check, they are reversals of what? Of the receipts. They must go to the CPJ. Stale check is the reversal of a payment. They must always go to what? To the CRJ. Again, this will make sense by the time when we record in the books of accounts. The timing differences, remember what I said? The timing differences are those amounts which are appearing in our books, but not yet on the bank statement. I said the timing differences are always recorded in the bank reconciliation statement. For example, outstanding deposit. So the outstanding deposit, it means this deposit is appearing in our books, but not yet on the bank statement. Outstanding checks means these checks are issued to pay someone, but they are not yet reflected on the bank statement. So they are called timing differences. They go to the bank reconciliation statement. Remember, sometimes we made errors. Remember, I told you that you need to check who made the error between our business and the bank. Okay? Errors made by our business, meaning made by our accountants, will be rectified in our cash books. But the errors which have been made by the bank will always be recorded on the bank statement. For example, here, if you can check, the bank understate. In other words, the bank made the error. Can you see its bank statement? The bank make the error here. So can you see overstate? The bank overstate. So can you see wherever there's a bank, we always record in the what? Bank reconciliation statement. So in other words, this information will reflect on the bank statement. Remember, here I was trying to say, sorry guys, here I was trying to write bank reconciliation statement. You can write for me. Here is bank reconciliation statement, bank reconciliation statement, bank reconciliation statement. So the bank understate a check on the bank statement, it means we go to what? Bank reconciliation statement. If the bank overstate a check on the bank statement, it means we go to bank reconciliation statement. If the bank let's say understate a deposit on the bank statement, we go to what? Bank reconciliation statement. So here you can just write here bank reconciliation statement, bank reconciliation statement, bank reconciliation statement. Okay. So, but can you see where the business makes the mistake here? Can you see we either go to the cash book payments or cash book what? Receipts. So what I'm trying to say here, you need to check where does the mistake appear. If the mistake appears on the bank statement, it means the error must be rectified under the bank reconciliation statement. Okay? But if the error was made by our business, the error will always be in the cash books. Depending on the error, we'll either go to the payments or the receipts. Again, this will make sense by the time when we go and look at a practical exercise. Again, remember, we must always satisfy this. Remember, the cash book must always be the same as the bank statement, but they are not always the same because of those differences that we talked about. That's why the bank reconciliation statement must balance so that we can say that we reconcile the differences. Okay, so please make sure that you go through this information so that you can understand better. So next time I'm going to show you an exercise. Maybe this will be better after dealing with what? An exercise. I hope everyone got it. So please study hard so that you can make it. So please study hard, guys, and then go through the study material so that you can be able to understand better. Okay, thank you very much, guys, and I will see you next time on Live.